Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Canadian Tire stock so we can determine if it's a buy or a sell. Canadian Tire operates retail stores that sell automotive, hardware, sports, leisure, and houseware products. They also operate Canadian Tire gas stations, Canadian Tire banks, Party City of Canada, and much more. The company is headquartered in Toronto, Ontario, Canada, and was founded in 1922. Let's get started with the model. This is a large cap company, 11 billion market cap. They're trading at $178 a share, and they have 60 million shares outstanding. We're looking at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had the most free cash flow in 2020, over $2 billion. 2021 it was cut in half to $1 billion, and it was negative in 2022. So it looks like they're investing a lot back into the business in the form of CapEx. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was highest in 2021 at $1.3 billion. 1.2 billion in 2022. Revenue is a sales for the company, and that goes up each year from 14.5 billion to 18 billion. Let's look at the capital structure. 5.6 billion of equity, 7.7 billion of debt. They have 42% equity, 58% debt. Their net debt is 7.2 billion, and their WACC is 11.5%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10.2 billion. We divide that by 60 million shares. And we get a calculated stock price of 171. They're trading at 178, so they're trading at a 4% premium. It's a sell according to the model. Simply Wall Street values the company at 106. They're saying it's 67% overvalued. 11 analysts priced this stock, and the average price target is 198. They're saying it's 12% undervalued. They pay a pretty good dividend yield. They pay $1.73 per share per quarter. That's nearly double from 2018 of 90 cents. That's a yield of 3.9%, which is 35% of their net income. This is where the stock has been trading since 2002. The first time it broke through $100 a share was at the end of 2013. In the beginning of 2018, it hit 175. When COVID happened, it bottomed out at about $85. Then throughout 2020, it shot up well past $200, its all-time high. It did come down to below 150, but now it's sitting around 180. So overall, the stock has done really well. It is trading about 10 to 15% below its all-time high, so there could be some upside potential, plus you get that nice dividend. There are 53 companies in the same industry as Canadian Tire, and Canadian Tire pays a higher dividend than average. Average is 1.3, the median is 2.2. Best Buy is 4.7. They rank 12th in market cap at 10.6 billion Canadian dollars. I converted all the market caps to Canadian dollars. Their price to book is equal to the median. They have a really good PE ratio, much better than the average, a little better than the median. We can't look at their price to free cash flow since they have negative free cash flow. And their price to sales is equal to the median, 0.6. That's a really low price of sales. So to summarize, I have them trading at a 4% premium. I rank their free cash flow as 4 to 10, their revenue 7 out of 10, and their ratio 6 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.